Get started. Hello again, and welcome to Saxo's webinar. A lot has changed over the last couple of weeks, and more so since we had this webinar last time. That was on our Q1 outlook, I guess, and we're now nearing the end of the quarter here. Already getting started on what we're seeing on the Q2 outlook as well. But yeah, we'll get to that with you soon. But for now, let's kind of obviously recap what's been happening in the markets in the last 2 weeks, particularly, which is, of course, extremely relevant and will set the tone for the weeks and months to come. So I am Charu Chanana. I'm a market strategist with Saxo Singapore. And I'm joined today with my colleagues Jessica Amir from Sydney and Redmond Wong from Hong Kong. I think I'm going to just kick off first with a bit of a macro view here. I mean, okay, a few lines on the disclaimer, but I'm sure everyone's aware of that. It's up on your screens now if you want to give it a quick read. And we get into the real stuff. So let's begin with what really changed things in the last few weeks. Of course, it was the banking sector, right? So what really happened there? So it started with concerns on regional banks in the US after 3 banks failed in the past couple of weeks. It was because of a bank run on SVB, but the US authorities stepped in to save the day. I mean, the keyword here is really they saved the day, not the weeks, not the month, not the year for sure. So in fact, last night, whatever assurance the authorities has given has also been taken back, or at least the markets assumed that there was some assurance from US regulators that they would kind of do what they did with for SVB for all the banks in the US, but yesterday's comments kind of trashed that hope. So the problem was really simple. This bank, SVB, had a disproportionate amount of investments in US Treasuries at the long end. Those investments were losing value because of the rapid increase in Fed interest rates. Fed interest rates go up, the value of your investments go down. So now this was basically an unrealized loss, but the depositors, they started to ask for withdrawal of money. Maybe they had concerns on the bank. I'm not sure, but it's also a signal that working capital was being pressured. Again, it could be because of inflation, because of high interest rates prevailing in the economy now, and that obviously impacts small and medium enterprises a lot more. So they wanted to withdraw their deposits to meet their working capital needs, to meet their payroll demands and the likes. So SVB had to sell its bonds at a loss. They had to realize those unrealized losses to keep up with the demands of withdrawals. The depositors particularly realized this, that not all the demands would be met, and we had a bank run. Anyway, like I said, the regulators did step in at that time to support the depositors of SVB, and a systemic event was avoided, with depositors being made whole. And then I think, well, the risk still remained, and the markets were still coping with that. We had a second event in Europe now, where which was obviously something that was brewing for some years, I would say. So we had the Swiss National Bank broker a deal for UBS to acquire Credit Suisse. The highlight of that deal was the AT1 market, a new term which many of us potentially, I think, learned in the last week or so. The message that the market got from that deal was that these subordinated debt holders should be prepared for to face more and more losses in times of trouble. So that was really a shock for the markets. Other European bank regulators did rush in, and they tried to kind of reassure the markets and confirm that whatever happened with the Swiss way of dealing with it, that won't be the blueprint for future bank troubles in Europe as a whole. So this did calm again the markets a little bit, but it's not like the uncertainty was completely removed. I think we still have a lot of uncertainty going. A lot of uncertainty hanging over the markets still for now. And then, like I was saying earlier, last night we again had these banking sector risks reemerge, with the US Treasury Secretary Janet Yellen saying that regulators will not backstop all deposits in all US banks. It's obviously, it's something that's not possible. Even if it was possible, it just did not make sense given how the banking sector functions, this is not something that they should have potentially done, and they are not doing it. Now, this is a big risk for the US Open today. We could see more bank runs happening after the announcement last night. There's going to be some amount of panic, some amount of stress in the markets, in this depositor community as well. But even if that wasn't going to happen, I think market will continue to anticipate that it will, and there will build stress. We've continued to highlight, in our research pieces over the last 2 weeks about what are the key credit indicators really to track here. So I think you can obviously look up on those pieces on the Saxo platform also, but I'm just showing you here 2 of them, which are really key to track again going into today's open, in the US market. So the FRA OIS spread, this is the spread between US 3-month forward rate agreement and the 3-month overnight index swap rate. So if you don't want to get into the details, this is basically a funding stress indicator. Now, this when the SVB issue happened, this spiked up to its widest since March 2020. It has somewhat cooled since then, but if it rises again and if it remains elevated, we could potentially get a signal. That will be a signal that the market is extremely fragile, extremely vulnerable to some further shocks as well. And secondly, if there is funding stress, that that does mean margin compression for banks as well. So I think that's again continues to say that the whole sector is in a really difficult situation. I mean, we're not saying that there are systemic risks, but there will be some pockets of risk somewhere in the sector which potentially could emerge in weeks or months to come. The other key indicator to track will be the financial conditions in the US, which have again tightened the most for this cycle, mostly due to the widening in credit spreads. Now, this is important, not just because you want to monitor what's happening in the credit side of the economy, but also for equity investors, because this really impacts the growth outlook for the economy. It really impacts what risk premium is being demanded by equity investors as well, and it basically has an impact directly on the economy compared to a large interest rate hike, which takes time to trickle down and show its impact. So also another thing that probably is not in the slides is, you should also be watching the credit rating downgrades in the US banking sector. So we had some of those last week. Moody's cut the outlook for the US banking sector as a whole to negative from stable, and placing some of the US lenders on a review for downgrade as well. If you do see those credit rating downgrades picking up, the First Republic situation, I think, is also still not resolved for those who are following that. So hard to say that we're just out of the woods, even though the authorities have signaled that they stand ready to step in to avoid any contagion, but also they've said that they won't be backstopping everything. So like I said, it's not a systemic risk, but there are pockets of risk and pockets of uncertainty more so, which is something that we will need to continue to consider in our portfolios as well. So, like I said, this is a big risk factor which you need to consider in your portfolios. Consider whatever happened in the AT1 market that has sent shockwaves to other areas of credit as well. Corporate credit, it has felt the pinch because of the bearish run continuing. Now, in the US, even the scare of bank runs, which is which could potentially, like I said, last. We could see some more of it today, maybe in the weeks to come. That's the fear will still be there, means that bank lending standards could be materially tightened. What does that mean? That means that banks won't lend money as easily as they did earlier, and that could mean credit growth could choke. A lot of companies operate on leverage. A lot of them operate on borrowed capital. And as you see here on the slide, even if we just look at the smaller lenders, they comprise about 50% of overall US commercial and industrial lending, 80% of commercial real estate lending. And when banks tighten lending standards, again, as I was saying earlier, this impacts the economy, the financial conditions, the economy in a more direct way compared to a Fed rate hike, which takes time to trickle down. So clearly, if banks don't lend easily, companies have to scrap some projects, which means unemployment could rise. All this while inflation still continues to be a problem. So coming from a from a point where the start of the year, started to suggest that we could get a reacceleration in growth due to China reopening or because of a strong labor market in the US, we are now at a point where growth is likely to slow down. We could call it a stagflation or a recession or a soft landing or a hard landing or whatever, but growth is slowing. And when growth is slowing, does that mean that the Fed will cut rates? Well, that's the next big question, right? So we had the Fed meeting yesterday night, Asian hours, and they raised rates by another 25 basis points yesterday, despite these financial risks brewing in the economy. The dot plot, which is a signal of where the Fed rates could go in the years to come, it did not move much. So the median projection from the committee, it is still signaling a terminal rate of 5.1%, same as in December. Market is pricing about 4.9%, which means we are there. So yesterday's increase of 25 basis points got the interest rates to 4.75 to 5%. So we're already at the terminal rate, which is being priced in by the markets, 4.9%. And the May of pricing, it does not look like it's signaling a hike at all right now. But the discrepancy, the bigger discrepancy, I would say, is that the Fed is saying no rate cuts in 2023, while the market is still expecting about 100 basis points of rate cuts this year. But again, even if the Fed was to pause now, I mean, we've had this since late last year, early this year, Fed pivot excitements. Can we still continue to be excited about a pause, a pivot from the Fed? Is this still bullish for the markets? With the recession concerns rising, I would say, financial risks are also rising. I would say, it is, I think, something that we need to be really cautious about. Two things. One is that the Q1 earnings season that's coming up after this quarter ends, and then mid-April we should start to see companies reporting. I think a lot of companies would have to adjust their outlook lower in light of these developments, rising recession concerns, rising financial risks. So that pressure could come through, one. And two, even from a valuation standpoint, near-term yields could slip lower, so that growth that does help the growth stocks, the Nasdaqs and the tech stocks. Like if yields are going down, that can obviously be supported in some way or the other. But remember that as recession concerns start to be priced in, risk premium for equities will go up, and this will be especially true for small and medium businesses that are better reflected in, say, a Russell 2000 index. Those are the kind of businesses that usually get hurt more in a recession. Also, just I think talking very briefly on what's happening elsewhere, which is of course the ECB or the Bank of England. They are both still showing intent to hike rates. Inflation remains a bigger problem for them, and they were late to the tightening cycle to start with as well. So as you can see here on this chart in the slide, this is showing the distribution implied by options on June Euribor futures. So what I'll just be I think a little bit more direct about what this chart is trying to show is that we have moved away. The distribution has shifted down and widened substantially after, previously it was reflecting only a narrow range of possibilities for where the rates will potentially top out. But now those possibilities have widened. The rates would potentially not go as high as what was reflected earlier, and the possibilities have widened. And that's the route I think all the central banks are taking. Of course, it's looking like their terminal rates are going to be lower than what was priced in earlier. Well, for now, the ECB has that leverage to continue to hike because inflation is still a problem, because China reopening is supporting growth in some way or the other, and the banking sector risks are particularly not as pronounced as, like I said. I mean, I would still think that the credit CS issue was very one-off compared to an SVB, which can still have larger implications. I mean, I think we can still have fallout from the CS issue as well, especially because of the wiping out of the AT1 bondholders. But it is still not a reflection of the health of other European banks as much as the SVB is, I would say. So we do have the Bank of England meeting today as well, and we had a blast in UK CPI yesterday. big reacceleration there, both on the headline and the core measures. BOE may potentially hike another 25 basis points today. I think they have to, but the future path will also be more important for them because, I mean, for them, recession concerns are slightly more pronounced than what it is for other developed markets. So can they continue to hike? So I think, I mean, that's an important consideration to make for those of you who are especially FX investors and look at euro or sterling. But overall, I think before I close and pass on to my colleagues here, I think the message really is simple. Growth concerns are rising. 2-year yields may go down, but can that mean equities will rally? Potentially not, because risk premium is going to go up. Near-term pressure is going to be there on equity, especially into Q1 earnings. I would be really cautious. So there is a need. As we've been speaking with clients over the last few weeks since this banking crisis emerged, obviously people want to de-risk, and we'll obviously my colleagues will also get into those discussions, but explore safer products. It could be fixed income, it could be gold, it could be Japanese yen. Typically, these are the ones that outperform in recessions. Also diversify, and Asia is really providing a kind of a calm in the storm right now, be it in the credit space because it's just more domestically focused credit here. Banks are usually more state owned compared to in the developed markets. So whether it's in the credit market or also the implications of China reopening are still flowing through into the region as well. So I think de-risk and diversify really is the key message here from my side. And I'll stop here and pass it on to you guys to take it over.
I thank you, Charu. And I think, Charu, you make a very important point on the credit contraction in the banking sector. I think we talked about it in our last presentation here, and about that is since November. Since November, the Federal Reserve actually has moved to kind of risk management kind of mode of operation. What do we mean? Because the Fed themselves, they know, and there is also their purpose. And after they raise rates so rapidly in such a large amount within such a short time, they are waiting for the economy to slow down. At the same time, they are preparing for something to happen in the financial markets and to slow down, to reduce risk taking. They are not so sure where those things will be coming from, those risks will be coming from, how big, how fast. So that's why since November, we have been seeing the Fed and hearing from the Fed. They start talking about the risk of overdoing it or underdoing it, and how to balance the risk of containing inflation and avoiding into a recession, and also whether in the process they are going to break something in the financial market or somewhere. So that's why they downshift. They move from 75 basis points, and now back all the way down to 25. And in the statement, in the minutes, you can see that they start talking about risk more balanced. And now, as Charu mentioned, something has happened in the banking sector, and that is trigger, is presented as a risk event. And even though that means it's
Redmond, we can't hear you. Maybe there's a problem with your microphone. We can't. We lost you for the last 2 minutes or so. We can't hear you. Maybe you can fix it, and Jess, maybe you want to take over first and talk about the equity space, I guess. Jess, you're muted.
Well, this is exciting, isn't it? What a very exciting time. All right, let's just pause on China. Our very esteemed colleague who covers China or the Greater China region will be back online in a second. So in the interim, let's just cover what we are looking at in terms of equity baskets at the moment. And what I'm sharing with you on screen, I'm sure you've heard it many times on Saxo's Market Call, the podcast, and I'm sure you've been well aware and sticking to your Saxo terminal under research and stocks, where we filter the Saxo equity theme baskets. And what we're highlighting here is the performance. So the performance is filtered by, as we can see, 1 year return. And the 1 year return, we've seen front and center, the defense sector has really dominated in terms of performance. So the defense sector is generating a return of about 19%. And then if we have a look at the intraday move, we saw on the back of the Fed decision, equities were quite volatile last night and they did end lower. But one thing was for certain, and that was the defense sector or the defense equity basket was the standout performer. So I guess this really demonstrates why at Saxo we advocate for clients having a diversified portfolio because we can see when the chips are down, some sectors are still shining. The other sector that's been doing particularly well of late, we can see second from the top, is the luxury theme. Now this is on the back of we've launched this theme on the back of China's reopening, and we're seeing those really high-end brands do particularly well with the rise of the mass affluent and indeed the middle class consumer in China increasing their spending. I'll just fast forward now to the defence sector. So just while we're at it, speaking about defence, so I guess it would be remiss if we didn't point out why Saxo has been advocating that clients have a portion of their portfolio in the defence sector and also commodities. But if we just focus on defence now, cast your minds back to when Russia launched an attack on Ukraine. We saw the NATO alliance really echo their calls louder, pushing for the NATO alliance countries to make a pledge and put 2% of their national income or GDP towards defence. And what's actually happened since then is we've seen a lot of long life shelf contracts. We've seen the US increase their purchases to send I guess, support to Ukraine. And we've seen many other countries do the same thing. But all in all, this really underpins the growth of the defence sector and also that we're continuing to see long shelf life contracts entered into by other regions around the world that didn't necessarily have large contracts before. And they've undertaken large contracts with some of these companies that you can see on the screen. I'll give you an example. BAE Systems, you can see that's towards the top of the equity defense basket that we track. And BAE Systems has been a beneficiary of the newly formed AUKUS alliance. And who is AUKUS, in case you've been missing our commentary? So the AUKUS is a tripartisan alliance with the US, the UK, and Australia. And the three countries basically came together to shore up their defence capabilities between the three nations and really. Just quoting a quote here to basically to rise up against China and their physical defense capabilities in some of the seas across the Asian region, particularly in the Pacific. So if you think about the magnitude of money that is going into this sector, it's around $470 billion. And BAE Systems is going to be a beneficiary of that, and they're going to be developing about 30 submarines, which the Australian government will purchase as part of the AUKUS alliance. And then we also think about other companies such as Lockheed Martin. So Lockheed Martin has been a beneficiary of defense weaponry, artillery, machinery capabilities also being needed, not only because of the war in Ukraine, but also thinking about the AUKUS alliance as well. They actually said that they need to increase their weaponry between the three nations as well to step up defence efforts in the Pacific. Something else to mention, as Charu has spoken about, and Redmond will also reinforce, we do advocate for clients to have some risk minimisation in their portfolio. And you've all, or some of you have answered our polling question. And I'll just pause there on the polling question. If you do have questions for Charu, Redmond, and myself, please feel free to use the question section on our facility that you can see here, and we'll answer all of your questions at the end of the webinar. But just going back to what's in front of you, it's really interesting to see what has garnered the most flows this year. And Saxo's commentary, as Charu mentioned, a lot has been about taking a defensive stance on your portfolio. So defense and being defensive are two very different things. We've been speaking a lot about protecting your portfolio in case there should be another market downturn. And indeed, we've seen bond yields, which Redmond will speak about, do particularly well. And if you have a look at the second from the top, the Spider Bloomberg 1 to 3 month T-bill ETF or Treasury bond ETF has garnered inflows to the order of $5.3 billion. So $5.3 billion has just gone into that one ETF this year. To put that into context, what company can you think about that's worth about $5.3 billion? Well, here's one, Norwegian Cruise Lines. So that's about the same value of the flows that we've seen into this ETF. You think about that further down under. So everyone knows Domino's Pizza Enterprises. So if you almost triple the size of Domino's Pizza Enterprises, that's the same amount of the value that has gone into this defensive treasury bond ETF. And at Saxo, as Charu mentioned earlier, having short-term exposure into bonds is actually something that we're advocating for as well. What I might do actually is pause and see how our colleague Redmond is going, and if he's able to join this exciting party.
Hi, do you see my screen?
Yes, we do.
Yeah, okay, excellent. Okay, sorry about that. I hope that is okay. Maybe then I hope I'm not repeating too much because I'm not so sure where I got dropped off from there. Anyway, it's I think now we look at the 2-year Treasury chart, and I think it's haven't talked about the credit contraction and the risk of a recession, and the Fed become more on a risk management and mentality to balance inflation versus recession risk and some financial stability. And they are preparing because when they did the hiking, they actually they raise interest rate. They are preparing to slow down the economy. They are preparing to tighten financial conditions. They are preparing something will happen, but they just have to manage it, the risk and balance it. So look at the chart here. You can see, I mean, the 2-year yield has been very choppy lately, but we see there's still quite a lot of room for it to come down. And as the Fed, we think that is now they have done 25, but then in May they probably may not even do it, and they are near to a pause. We don't exactly we know the timing, but they probably I think will ease monetary policy in order to balance the risk. The inflation still quite high, but the risk now is more on also financial stability will be a key consideration. But why just 2 years? And if you look at the chart here, and every time when the Fed pause, in this chart you see the green line is the Fed fund rate. So when it goes up, the Fed is raising rates. When it comes down, the Fed is cutting rate. And I circle the 3 occasions with the red circle, and those are the time the Fed pause. And the green line, the blue line is the yield curve. And so that's the 2-year versus the 10-year. So that is when it's very steep above 0. That means it's the 10-year yield is higher than the 2-year yield. And when it came down to very negative, and as like back in earlier, just a few weeks, a month ago, is as negative as 1%. That means it's the 2-year actually is yielding even higher than the 10-year. So when it's very negative, may mean that the market think that the monetary policy is very tight, and the Fed and there will be a recession coming, and also at the moment the rates are too high. And then it's when it's really, and when the Fed start pause and start easing, that means, and then the short-term yield will come down, and the longer-term yield will come down or less, or maybe even rise, depends on the expectation on the inflation. When the Fed easing, inflations, is that and depends on the level of the inflation, the expectation as well. And also affecting the shape of the yield curve will also be the volatility of interest rate. And so when interest rates are very volatile, you need more premium for holding longer dated bond. That means is that the curve will also steepen. So historically, when the Fed pauses and start easing, the curve will steepen. In other words, the 2-year, the short end, 2 to 5 year Treasury bond, Treasury notes will do better than the 10-year notes or the 30-year bond, and in most of the situation. And in this time, especially where inflation is still very high level and not coming down fast enough, and if the Fed has to pause because of risk management, have to manage the risk of financial stability, and also to prepare for the credit contraction, the impact, as Charu mentioned, when the bank are not lending or tighten their lending standard, there's very contractionary, just like a tightening by the Fed. So that means is in that case, the short-term rates may come down further faster, and the long-term rate may stay a little bit come down less fast. So it's good to park the money and to add to the portfolio some 2-year and 5-year Treasury, and the yield is still at 3.95, and the 2 years we still see some quite a bit of room for it to come down, i.e. the prices of those 2 years Treasury will go up. And here, so why don't we want to buy some corporate but just staying in the Treasury? On this chart, you can see that for the red line is the and the orange line are the lending standard of the bank, and on commercial and industrial loans. And so the red one is for us is lending to the large to medium size corporate, and the orange line is the lending standard for small corporate in industrial and commercial loan. So you can see and every time, and they gone up before a recession. And recently, and in the last 2 survey, the Fed is doing this kind of survey every 3 months. The last time they did it is in October. The last 2 times, October and January. So in the January survey, which was released in early February, and you can see there's a big jump or big tightening on the lending standard. That's actually before everything happening to the regional bank. That's even before those fiasco or those problem in the regional banks and emerge. In fact, bank has already been tightening lending standard since October, and more so in January. So in the survey in the January the January survey that the Fed did. So when the Fed, when banks, remember, I mean, the bank, the Federal Reserve is creating money, creating the monetary base, providing the monetary base, but actually to create money supply, to create credit is through the banking system. So the bank have to lend, and in order to monetary base that the Fed print or create have to be actually become credit and become money supply. So when the banks are slowing, and that will be quite contractionary. And so and that is not going to do well for corporate spread. And even before whatever issues about the additional tier 1 capital or perpetual and subordinated debt, even before all these, and bank tightening lending standard has an impact, a negative impact on the corporate spread and will widen the corporate spread. So the blue line on this chart is the investment grade US corporate credit spread. So you can see in the past 3 recessions, every time when the bank tightened lending standard, the spread actually widened and together. What does it mean? It means the corporate not only getting more expensive money or more difficult to borrow from the bank, and it is also will be more expensive. Actually, has been also been more expensive to issue bond in the bond market, even for investment grade corporate. And in this time round, the investment grade credit, the spread has not widened as much as the bank tightened the lending standard. You can see there's a divergence between the blue and red line versus between the red and orange line versus the blue line. So that means the bank has tightened lending standard, but the corporate bond spread has not widened sufficiently to catch up. So that means that translate to investment. It means is that will be less attractive to put your money in the corporate bond, but better to stay in the US Treasury. So talking after we have been talking so much about Treasury, so where we can find some of those US Treasury bond, and if you are a Saxo client, you can go to the Saxo platform and you can use the filter, and in the filter you select bond, and then you can select government as the issuer type, and then you select United States as the country, and then you can also specify the maturity, the tenor, how long you want to what kind of bond. You say, if we, as we discussed, probably the value more on 2 years to 5 years, so that you can in your screening in the filter you can select anything between 1 to 5 years, and then you can find some bond there, and you can see the price and the yield is all on the platform. And so you can, when you have time, you can take a look. And now we shift gear a little bit, and we talk about China. And China is in a slightly different cycle, and China is in a cyclical upturn. Especially, I just choose one chart for the sake of time. It's the credit impulse can summarize quite well, as I think we probably have seen this chart before. But it's just an update. And this credit impulse is the growth of the aggregate financing, all the loans, all the credits in China as a percentage of China's GDP. And the way we plot this chart, because there's a time lag, so we plot it, push it 12 months forward. It say, okay, the impact may be only comes about 10 to 12 months later. So on this chart, you can see we put the credit impulse 12 months forward, and on this chart you can see the credit impulse and indicating the economy is recovering throughout 2023, especially in the first 3 quarters. So the recovery is likely to be picking up and continue to pick up from here, and we have seen some recovery already from the latest PMI number and so on. And but we expect that will continue and all the way through to the 3rd quarter and the 4th. And one caution I want to emphasize: we are calling for a cyclical recovery and growth in China, but we agree, and we expect for the structurally and the secular trend of growth in China has come down to has slowed, and we are not seeing those 7% to 10% or not to mention double-digit kind of growth in China in the years to come. So we think that the growth target from the latest government report from China we had earlier this March is talk about at least 5%. We think that is a reasonable target to is doable, and China can probably get that, and that will still be spell well for the equity market in China. And also the real estate market stabilizing, and also there will be some of those, a lot of those infrastructure spending, and also those credit creation we just mentioned about, and the impact, the multiplying impact will gradually kick in and push the economy going forward. But again, that is a cyclical rebound. It's not a structural, very strong growth. And because of China is, I think we also mentioned, but I just want to reiterate here, China is facing aging population, and also facing with limit on resources. And so the rate of now is in transition to a new growth economic development strategy, and that will take time. And in the process, during the it will the growth will slow to around this kind of 4-5% level going forward next year. So I think, yeah, I mean, still a buy in Chinese equities and in the next few months, but towards the end of the year next year, there will be again volatility will be high again. To just take a look on in China what to buy, and I think we continue to like infrastructure, but at the same time this year in the early stage of a recovery, and also is return of the Chinese consumer, and we think that China consumer stocks and also technology stock will do well, and in the coming months. So to have more ideas of what kind of companies and so on, you can go to the platform and the Saxo platform, and you can check. We have a China consumer and technology equity basket, and you can see what kind of names there. Those are more exposed. Those are companies. Those are not stock recommendation. It's just a sharing of what kind of company have more exposure to the Chinese consumption and technology sector. And I think this is a film basket my colleague Charu created. I think that's an excellent basket because it's during the reopening of China and the return of the Chinese consumer. And one thing is Chinese tourists will go out again, and this is both to overseas and also domestically tourism is going to pick up. And so we have this APAC tourism equity theme basket. Once again, you can take a look at it. It's not stock recommendation, but we just highlight some of those more important company in the sector, and those who tend to benefit and have more exposure to tourism in this region. You can take a look in our platform. And I think I stop here. And Jessica, I think I pass it back to you.
Thanks, Redmond. So thank you so much to all of you who have been answering our poll questions, encouraging you to vote on those. Really interested to see, or we're really interested to see your responses. And please do, we've started to receive some questions, but please do feel free to write your questions in at the top, and we'll be sure to answer those at the end. But let's just continue now with more of our thinking. So Fed and Red, I was going to say Red for Redmond, but Redmond and Charu have been talking a lot about the Fed. So, and you all, thank you very much, have some of you have voted on our poll question on the back of the Fed meeting last night. And I guess your answers pretty much reveal that you're sitting on the fence. You don't really know what's going to happen to the Fed fund rate in May. So the majority of you think that the Federal Reserve will hike rates in May. now the numbers are actually going up. More are actually saying that the Federal Reserve will hold rates. So I guess we speak to this cohort that have voted on the Fed pausing rates now, and we just encourage you to think about the scenario which is in front of you. So this is a chart that Ole Hansen, our head of commodity strategy, has prepared. And it essentially highlights what some of you are saying, with most of you now voting that the Fed will pause on rate hikes in May. This illustrates if the Fed does pause rate hikes and doesn't make any hikes in May, that we could potentially see gold rally to the upside. Remember the last 3 times the Federal Reserve has paused interest rate hikes, i.e. the Fed fund rate has peaked. We subsequently saw gold rally. So what you can see on the right-hand side of the chart now, I'm just going to make it full screen so you can see that. What you can see is the gold price actually rallied up 62% from its low at the time to a new high. So if this scenario plays out again, we think that our outrageous prediction, if we do see this 61% move to the upside, if this happens, our outrageous prediction, which we made last year, of gold hitting $3,000, that could potentially come true. Now, what's really interesting is this week in Australia, the gold price hit a brand new all-time record high. That's in gold Australian dollars, and that is benefiting a lot of the Aussie gold companies. So remember, the world's second biggest gold producer is Newcrest Mining. They're listed here in Australia. Of course, the world's biggest gold producer is Newmont, and they're listed in the US. Speaking about gold, in US dollars, the gold price popped over the $2,000 US mark for the first time in over a year. So this bodes really well for companies like Newmont. So again, just a reminder here, it is worth considering, and we advocate that some clients, or we advocate that I should say that clients do have some of their exposure or some of their portfolio exposure towards gold. Now on the platform, you can buy gold contracts, you can buy gold equities, so gold stocks, and you can also buy gold ETFs. When you are thinking about ETFs as well, I'm just going to fast forward. No, I won't fast forward. Rather, sorry, that's a bit confusing going back and forth. But I'll just point you now, I guess, to a part of our website. So under research, you'll be able to find the ETFs on the platform and some educational literature as well. So if you click on research and then click on ETFs, you'll find how to navigate around the ETF market. So shifting gears now, so we've spoken about the US dollar, I guess, paring back from its high. However, what we are likely to see once going back to your poll, if the Federal Reserve does pause and then cut rates, like some of you have voted on and some of you are saying, even though the market is not likely to see cuts this year, if we do see cuts, that's going to likely push down the US dollar, and that of course bodes well for commodities. Commodities are of course traded in US dollars, and we know that commodities typically rally to the upside when there's a cheaper or when there's a lower US dollar. Now at Saxo, you probably know that our preferred metal is copper, and there's a good reason for that, is because copper is not only used in the EV transformation, but also the majority of copper demand is actually from the building and construction game. And we know with China being the largest consumer of copper, this is going to bode well for copper. And this is why the copper price is back above the key $4 mark again this week. Also this week, keep in mind, we've heard some of the largest copper companies in the world, and they actually see the copper price hitting a brand new record all-time high this year. Now you can invest or buy copper via copper contracts. You can also look at various copper companies. One of the largest companies in the copper space is, of course, BHP, who's looking to expand their copper repertoire and buy Oz Minerals. So that's just two examples of how you might potentially think about copper exposure. Just rounding out the copper conversation, the market is expected to remain in deficit, as in there's not enough supply to meet demand, and that deficit's probably going to play out till 2040. This basically demonstrates the copper supply has been in a glut for some time now, and this is because of a lot of reasons, one of them being an environmental issue. Also, secondly, there's weather. Weather impacts have caused a lot of copper producers to actually downgrade their production. And the third reason is that copper production is also a copper investment, has been declining since 2013. And the final thing to consider is it takes about 11 years to get a copper mine up and running. This is why at Saxo we say mining is quite inelastic, meaning it takes a long time to get a mine up and running. And this again goes back to why Saxo, we advocate that clients do have some of their portfolio in commodities. Speaking about commodities, if you don't know where to look, or if you're looking for inspiration, on Saxo's or as a part of our equity baskets, which you'll find under research and stocks, you'll see our equity baskets, which we've mapped out to provide inspiration. In the Saxo commodity equity basket, you can see some companies that we've spoken about, including the copper giant BHP, which is there. And then you've also got a mix of other companies as well. So you've got some fossil fuel companies. We know that that the oil price pretty much has been in a downtrend for some time. So the oil price is down about 12% this month. But we don't really see the oil price picking up until potentially later on in the year, maybe even as soon as potentially next quarter. But that's something that we'll touch on in our quarterly outlook, which is coming out soon. But also in this commodity basket, you've also got diversification across other commodities, including soft commodities, as well as fertilizers. So, i.e., Mosaic is one of those companies as well. We also spoke about Newmont. So, Newmont is the gold giant, and you can see them pretty close up to the top. Again, just a source of inspiration if you're looking at potentially buying some commodity companies. And just rounding it all out, I think I'll open up the conversation to all of the strats now to chime in before we move to your questions. But we just wanted to really summarize some of the key takeaways that we've gone through today. So we've spoken, I guess Charu opened up and she spoke about the turmoil in the banking sector, particularly in the lending part of the market, being still quite up in the air. It's not resolved because of what Charu highlighted was the ATIs essentially. So we are advocating for protective puts if you have long positions, particularly in some of those S&P 500 names or in some of those Dow Jones indices names. We're also, again, just reiterating our gold messaging. You can look at gold contracts, gold stocks, and Charu is our resident FX queen, and she speaks a lot about the Japanese yen, and the JPY at Saxo, we think does offer some safe haven protection, and for good reason. Redmond, our resident bond expert, bonds, as we spoke about and as we illustrated, are increasingly being act as a cushion in terms of downside. So we've spoken a lot about volatility remaining front and center this week, and we've seen a lot of flows go into bonds as well. Do either of you want to chime in and just add to the key takeaways here now?
I think also just reiterating just what I spoke earlier. I mean, this is obviously a time where most of our clients are, like looking to de-risk, and you've already shared what options we have for that. And also, I think diversification is also certainly, if you're a long-term investor, I think Asia does provide a lot of good, value still, because the valuations have been so poor. They've been pushed lower, even more now because of these banking crisis concerns. But I do think that this time, and there's been less tightening around in Asia, and that does mean that the impact on the financial risks, the financial risks are not going to spike up the same way as they did in the developed markets. So I mean, I think again, but that's certainly not from a trader perspective, but more for a long-term investor. I think diversification is really key, but overall, I mean, I think just continue to look for kind of quality stocks with strong earnings and cash flows. I think that will be really important. And what I said earlier, tech stocks or growth stocks versus, the small and medium enterprises. So, Nasdaq versus Russell 2000, that spread potentially could be extremely interesting as well.
Yeah, absolutely. I'll just add on to that, if I may. Brilliant points. So just echoing what Charu has said, it's really interesting. So we spoke about a lot about the bank sector turmoil, and so we saw the KBW bank index has I guess you could say has plummeted, while inversely what we've seen is, as Charu mentioned, those larger Nasdaq 100 names. So Nasdaq 100, the biggest tech stocks in the US. So we've seen some of those names. I'll just throw a couple in the air. So we've seen Alphabet, which is the owner of Google. We've seen Microsoft, as well as Apple as well, I guess outperform some of the other benchmark indices that we've seen come into a bit of turmoil of late. So it's really interesting to see that some of these large tech quality names who've got strong cash flows and strong loyal customer bases, they've actually continued to hold up quite well. And I think just summarizing, also rounding out this conversation on tech stocks, what Charu mentioned as well is quite poignant. And Charu spoke about the tightening of liquidity. When we speak about the tightening of liquidity, just again going back on what Charu said, the accessibility of funds in the future is going to be a lot harder and a lot stricter. This basically means that companies, like the Alphabet, the Google parent owner, the Microsoft, for example, the Apple, a lot of these companies are going to experience a lot less competition in the future because the accessibility to capital is absolutely going to dwindle away. So it's going to be a lot harder for companies to get funding in the future. So that also does mean that their moats, I guess their accessibility to really capture market share from these companies is going to be increasingly hard. So that just adds to that theory that we're speaking about there. Sorry, Charu, back to you.
I think we can just go to the questions. We're running short of time, right?
Yeah. All right, so let's go to the first one, if that's okay. I think this one might be for Redmond. So we asked, do you invest in bonds? And some 20% of respondees said that they weren't sure how to invest in bonds. Redmond, do you want to take that question?
Yeah, I think first of all is when we look at bonds, we need to see, okay, what kind of maturities and also what kind of issuers. And we mentioned about, I think at the moment, you think that it's better to go for the highest quality. So that is US Treasury in dollar. And US dollar is always US Treasury, which is the most liquid, it's safer. And we also indicate the yield curve, and we say at the time of the Fed pauses, it's better to stay in the shorter end. It's going to benefit the most. So we look at those 2 and 5 year and bond. And at the Saxo platform, you go to the filter function, you select government and as the issuer type, and then the United States as the country, you can find a list of bond. And then you can just click on and take a look at the detail. And when later on going forward, if you want to look at some of the corporate credit and so on, of course, you also need to pay attention to the credit rating. And just like when you buy diamonds, you have different kind of grading, and the triple C, and in buying bond, you have all kind of say A, triple A, double A, triple B, or kind of different kind of credit rating. Those is also something you need to pay attention to. And but at the moment, I think we recommend to go for the highest quality. So I think I would recommend to go to the platform to take a look and select some of those U.S. Treasury, especially at the 2 to 5 year sector.
Great, thank you, Redmond. So for someone who's never invested in bonds before, in one answer, what would you, how would you like to remind people, I guess, in a different way of
Yeah, you look at the yield. Yeah, I think you also look at the yield, and at the platform, you look at the mid yield, and you how actually it's like a deposit, how much money, what kind of return I can be expecting. And if yields come down, and after you buy a bond, then it's like, and then then the value of your bond will increase, and then you got also capital gain. So you have number one, you collect the coupon, and then there's interest income, and also you have some possibility of capital gain. But of course, there's always risk involved. If interest rates go up and the value of your bond comes down, the price comes down, and you will also suffer a loss. So that, and actually last year, and for the most part of last year, bond price came down. There's actually the loss is also not small, it's quite big. But I think most of those increase in yield, interest rate increases has already happened. And so going forward, it's good to have some bond, some income, and especially now the yield is much higher. That means you collect higher income. That's very different 12 months ago.
Thanks, Redmond. Okay, I think before we go to the Fed question for you, Charu, I might actually take this one about commodities. So the question is, for the past few months, Saxo has been very bullish about energy, metals and minerals, commodities, renewables, tangibles versus intangibles. These sectors have been very disappointing recently. Has the house view changed? Great question. I'll just take the tangibles, intangibles section separately, because when we speak about tangibles, intangibles are typically technology, cloud companies. Typically, cloud companies carry high debt, and a lot of intangibles are non-profitable tech as well. And a lot of those companies are actually in the NASDAQ composite, which is much larger than the NASDAQ 100. And so some of those have underperformed. Whereas if you flip that argument on its head and you look at the tangibles, the first sector that we spoke about today in tangibles was defense. So defense is in things that you can see, you can touch. So a ship, a submarine, a Hercules plane. Remember, Hercules is needed in repatriation. They deliver cargoes to countries that need supplies. They repatriate troops. They helped people in COVID times. So they are outperforming. They outperformed the market last night, and they have outperformed year on year and year to date. Then to answer your question specifically about commodities, we do believe the commodity super cycle will kick in this year. And a big catalyst for that, to starting the super cycle, is a retracement, or is a pull down, or the fall of the US dollar. And so I guess for now, the scenario is that the US dollar is somewhat supported, but we do see that the US dollar will lose its heat, and that would support the commodity super cycle being reignited again. So our thinking was that this would initially come into play at the beginning of the second quarter, and that has not materialized as yet, but we still do think it is going to get underway. Speaking about other minerals, so you mentioned other minerals or metals, and so one of those is indeed gold, and one of those is copper. So the oil price has pulled back, whereas the copper price hasn't pulled back as much. And so with China, for the third straight year in a row, actually coming out and affirming that they're going to be more stricter with their emissions targets, this has caused the iron ore price and some of the other commodities to, I guess, not be as lackluster, or to be more lackluster. But nevertheless, we do believe that China is absolutely going to increase demand of commodities. So that is something that we continue to monitor. We still are bullish, but we believe it might have cooled. So we're just, I guess, waiting for the next catalyst. In terms of renewables, absolutely for the long term, we said in Q1 that copper, aluminium, and lithium were our most bullish, or we were quite significantly bullish on those. So we still do advocate that for the long term. However, for downside protection, we're seeing some clients use optionality to protect against the pullbacks. And if you don't know how to use options, we've got a team of relationship managers or global sales traders who can help you with that. Or you can contact our normal phone line, and depending on your region, our sales team will be able to help you with that. But I hope that has answered your question. But yes, we're absolutely still bullish on metals, mining, commodities, renewables, and still advocating for tangibles over the intangibles, because as we said, there's been a supply deficit, and that will continue to remain. And there's been underinvestment in commodities since 2013 when it peaked. Sorry, we're just running out of time, but I think I want to throw this question to Charu. So the Fed's decision next month, or what will they do? Do nothing, hike, or cut?
I mean, yesterday we were talking about what the Fed will do in the March meeting, and I think nobody had any idea. Expectations have been so split this time, from minus 25 to plus 50 basis points. I think saying something for the May meeting, I mean, I think it's more than a month to go. I think it's still very hard. I think it'll depend really on how the financial sector risks develop from here. I mean, I do think that will become a bigger factor now, and especially for inflation going into the middle of the year, we are starting to, going to see the base effect come through as well. So at least, from the face of it, it might look like, I mean, we certainly are past the peak, but it might look like the pressure is easing off. Although, I mean, again, we still do think that inflation is going to settle in high and potentially not go back to the 2% target that the Fed has. So that will still keep the task very difficult for the central bank. But whether or not they can continue to decouple their monetary policy from those financial risks as well will be completely dependent on how big these risks turn out to be. It's a big uncertainty, and that's why I think what Jessica's been saying, we've been talking about de-risking, we've been talking about diversification, but it does look like, I mean, I honestly, I can't give you a definite answer on that. It has to, as much as the audience is split on the poll, I am myself as well. And I think we need to just continue to watch these financial contagion concerns from here.
Great answer. And I think, I guess we should round it off with Charu's wonderful conclusion. In terms of the next point of call, you can refer to the slide that we've got on the screen now. And that's, I guess, the home of Saxo is where you can find all our daily insights and research. So depending on what platform you use, or if you use the public facing site, everything is available under our inspiration or research tab, depending if you're a client or not. They're generally the same tab and the same source of literature. And then of course, I guess the only way that you can access our baskets is once you've logged in, and they are under research and stocks. And don't forget to tune into our weekly outlook, the Saxo Spotlight, and also our daily commentary on the website, which is called the Quick Take, and you can also refer to our Saxo Market Call. Any questions, feedback, or comments, please reach out to your relationship manager or your global sales trader if you are a client. If you aren't a client, thank you so much for tuning in, and we'll hopefully speak to you very soon.
Thank
Thanks for
you.
watching.
Good day, guys. Stay safe. Bye-bye.
Okay, bye bye.
Bye.